It's 2:01, so I don't want to wait too long, but thank you so much for joining us today, and welcome to this afternoon's webinar, Dividend Deep Dive, AAII Dividend Investing Portfolio Annual Review, led by Jack Gilleland. Thank you so much for joining us, and we are happy to have you all here. My name is Jenna Brashear, and I'll be your host for today. A few things to go over before we begin. I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And a handout of the presentation will be available under the handout section of your GoToWebinar control panel, which is located on the right-hand side of your screen. And additionally, a copy of the slides used during today's presentation will be sent to all who attended today. And if you have any questions for our speaker during the presentation, you can submit them using the questions section of your GoToWebinar control panel. And then once our presentation concludes, our moderator, John, will select a few questions for Jack to answer. And questions that are not selected for the broadcast will be reviewed and addressed afterwards. And if you experience any issues with the audio or the video of the webinar today, please consult the instructions on how to change your device's settings, or you can consult the GoToWebinar support website for support at gotowebinar.com. And just a friendly reminder that this presentation is recorded and a replay of the webinar will be available tomorrow on the Dividend Investing website, along with links to this presentation's handouts and any resources that we discussed today. And that is at di.aaii.com. And for new viewers, we always like to give a little background about our organization. The American Association of Individual Investors is an independent, nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And with that, I'd like to hand over the presentation to John and Jack.
Well, thank you very much, Jenna, and I'd like to welcome everybody to today's presentation. And I know in this new world, the virtual world that we live in today, I've seen we've got many members from around the country. You know, Jenna herself is in the western suburbs of Chicago. I'm downtown in Chicago, and Jack, I think you're in Texas somewhere. Where are you in Texas?
Dallas, Texas, yes.
Dallas, Texas. I saw at least one member coming in from Texas today. I'm very excited about today's presentation. Jack is the lead manager and analyst with the Dividend Investing newsletter. He's been with our organization. He'll be coming up on 3 years, I think, this coming May. He's expert in all areas of stock analysis. He's studying up for CFA exams as well coming up. And he's also an expert when it comes to various spreadsheets and whatnot here around the office. So it's always an enjoyable time talking about him, except when he talks about the Packers, because I'm from Chicago and so is Jack, but he seems to be a Green Bay Packers fan. But I guess they're in the playoffs and the Bears are not. So I guess he's got something to smile about when it comes to that. So with that, Jack, I'd like to welcome you and like you to take control of our presentation today. And we're going to fade into the background here. We'll be looking at the questions that are coming in, and we'll post anything that comes up towards your way, Jack. Please go ahead.
Perfect. Thank you, John and Jenna. Like John said, my name is Jack Gilleland, and I am the lead analyst and editor of Dividend Investing here at AAII. I've been the lead analyst for about a year now, and like John said, I've been with the company for nearly 3 years. So today we're going to be talking about the AAII Dividend Investing portfolio, and we're going to give a little bit of an annual review. So our learning objectives for today are overview of the research and theory behind the DI strategy. So looking at why the strategy uses certain elements of different income investing ideas. We're going to look at the model portfolio construction and management rules, essentially looking at how we built the portfolio and the rules that we use to maintain the portfolio. Then we will cover the model portfolio and market performance for 2023. And finally, we will talk a little bit about dividend investing resources and where you can find them to help you make your own decisions regarding dividend stocks. So the DI strategy. So some benefits of dividend investing. Dividend investing allows investors to generate passive income. Dividends provide cash flow, usually quarterly payments, which then investors can choose whether to reinvest or use the money to invest in other stocks or back into the stock that pay the dividend, or they can use the money to use as discretionary income. A lot of people in retirement like to use dividend stocks to supplement their income. Dividend stocks also have a higher growth potential long term. So dividend paying stocks, historically, they deliver higher long-term results than those that do not pay a dividend. And we'll look at that a little bit later. Inflation protection. Unlike bonds, dividend stocks have the ability to increase their payments every year. So fixed income or bonds, as they're called, fixed income, you receive the same payment every year, whereas dividend paying stocks have the ability to increase their payments over time. Dividend stocks allow you to maintain equity. So if you invest in other stocks, to take profits, you then have to sell part of your equity in order to generate income, whereas dividends, they pay out that income, allowing you to maintain the same amount of shares over time, which then again you can reinvest or do as you please with those. Maybe increase your equity by reinvesting. Dividend paying stocks also tend to have lower volatility than those that do not. Dividend payers are often large and established financial companies and more financially established companies with a mature business cycle and steady cash flows, more predictable, and that can help in turbulent markets, as we've seen over the last couple of years, and we will get into that later. Also, it helps signal corporate financial health. So companies that have a dividend payment or increase their dividend payment, often people see this as a sign from management that the company is going to be able to cover that dividend into the foreseeable future. So when a dividend level is established, it can be a sign that the company is doing well or is expecting to do better into the future. So here's what I sort of hinted at earlier, the dividend growth being somewhat of a key to performance in the long term. So over the long term, since 1972, on an annualized basis, dividend growers and initiators have returned 10.24% versus the equal weighted S&P index of 7.68%. So dividend paying stocks often have more stability, but those who grow their dividend as well have the ability to increase your total return in the long term. So when investing, most of the time you should be thinking about a long-term horizon, especially when investing in stocks. But so dividend investing or dividend paying stocks, as you can see from this table, have the highest annualized return based on that total return strategy. So that would be the dividend received as well as the capital gains over time. On the other end, the dividend cutters and eliminators, they return some of the worst or the worst out of this group examined. So as we'll talk about later, that's why part of our strategy is when a company cuts a dividend, that is an automatic sell rule or an indicator to sell for our portfolio. Here's another example. So this is called compound returns visualized. So the red graph is the S&P 500 total return since 1970, and the blue would be the S&P price return. So this would be with dividends reinvested would be the red line. And so you can see the growth, and this is actually a logarithmic graph. So each segment equates to the same amount of increases over time. So while it might look like it's not outperforming that much, if you look to the y-axis, you can see the amount over time. I'll use my little laser pointer. You can see the amount over time. It starts to grow exponentially. So up here it's over $2 million, whereas down here it's around 500,000, and you can see that those two numbers down here. So total return can help over time to increase your returns, and that's what we try to accomplish here with the dividend investing portfolio. So here's the current annual payouts of the S&P 500, current dividend payouts of the S&P 500 stocks. So as you can see, it's been increasing over time. Obviously, 2020, the 1 year where it took a slight decrease. Some companies paused their dividend payments or cut them during this time. But for the most part, you can see the recovery was strong into 2021 and continued growth over time. So there's a quote down here from Howard Silverblatt. He's an analyst at S&P Dow Jones Indices. He covers the dividend payments, and if you've read DI over the last couple of years, we've quoted Howard a couple of times. He has a good Twitter feed as well, where he talks a lot about dividend paying stocks and the state of the S&P 500. So Howard said the number of dividend increases slowed in the fourth quarter as companies appear to be more cautious when committing to them. As markets moved higher and interest rates were seen near or at the peaks, dividend decreases significantly declined. So what he's saying is that it's slowing down a little bit, but it could be because the interest rates have peaked, and we'll talk about that a little bit more about how fixed income or treasuries can sort of compete with dividend stocks as we saw throughout this year. So moving on to the portfolio itself. So dividend investing seeks to find stocks with sustainable and growing dividends with the potential to increase in price and make larger dividend payments in the future. So we want stocks that not only are attractive in their valuation right now, but have a consistent history of raising their dividend, as well as the ability to do so into the future. So mainly we look at companies that are well established. This happens to make it somewhat large cap value tilt, opposed to maybe a large cap growth of more S&P stocks. But what we look at is sales, earnings, and dividend growth. So obviously sales trickles down there into earnings or the rest of the company. So increasing revenue is a good sign that the company is most likely then increasing cash flow and earnings, and that would give them the ability to increase their dividend over time. Positive free cash flow. Free cash flow is how companies pay their dividends. So we want to make sure that companies are using cash to pay their dividends, not necessarily finance debt, or they have the ability to do so into the future. And then attractive valuation. We look for companies that have their dividend yield is currently lower or currently higher than their 5-year average dividend yield. The strategy is based on studies of market factors that have contributed to long-term return. So as you saw previously, total return over time pretty much dominates the S&P return over time. And we also allow subscribers complete control. So as opposed to maybe someone who manages your money, or if you bought into an ETF, while you can buy and sell an ETF, at the end of the day, it could, if it's not benchmarked to an index, it could be up to the manager of that ETF or mutual fund to make the decision. So dividend investing allows individual investors to make their own decisions based on addition and deletion alerts, and then if they have specific tax requirements for the year, you know, tax loss harvesting, stuff like that. You can do that as your own. So you don't necessarily have to follow the addition and deletion orders, but we sort of create those to help help investors understand why we're making the decisions that we are, and then put it into their hands to figure out what they want to do themselves based on the information. We do a weekly commentary every Friday, as long as a newsletter once a month. The newsletter actually came out last night, so take a look at that if you have not already. And we offer a full archive of all of the monthly and weekly newsletters that we've ever published. So anytime that you want to learn something new about dividend investing, I'm sure there's an article that has been written about it already. The current model portfolio, so the model portfolio is a real investment account. It is with real dollar value. So since 2012, during its inception, it was funded with $100,000, and it has been growing ever since. So we focus on 24 stocks. We try to keep it fully. We do keep it fully invested at all times. There always has to be 24 stocks. It has to be exchange listed U.S. stock, and like I said, most of the time there is that large cap value tilt, just based on the profile of companies that pay consistent dividends and growing dividends. And we don't necessarily look for diversification. It kind of finds us on its own. You know, investing in a multitude of different companies, 24 companies. We have a large variety of different types of companies and companies that do lots of different things. As you can see on the right of your screen, there is the sample of some of the current holdings. So PepsiCo, BlackRock, United Health Group. A lot of these are well-established companies that people have heard of, and you know, have consistent revenues and the ability to then pay consistent growing dividends. We also look for stocks that pay monthly dividends only, and we don't look for REITs or MLPs. A lot of times those REITs or MLPs, they have different tax requirements or tax issues, so we try to stay away from those, just in order to simplify as much as possible. Currently, the portfolio yields are around 2.7%, whereas the market, which is the benchmark Dow Jones US ETF, has a yield of around 1.3%. We do have a proprietary strategy. You can find that at our quantitative screen. That would be the DI ideas list, and any stock that we ever add to the portfolio will have to come off that list. So it's a great place to look for potential investments. We also send out addition and deletion alerts whenever a change is made to the portfolio. Most of the time those happen on Fridays, which would be the newsletter day. So, but we will send out separate emails for those. And then there's also some former holdings here. So as you can see, Apple, Occidental Petroleum, AT&T, Microsoft, and McDonald's. Similar to some of the current holdings, a lot of very well-established companies. You might be thinking, why would we have sold some of these companies in the past? They're doing really well. Well, we're dividend-based, and we're looking for income, growing income. So companies that don't meet our yield requirements, or they have slower or no dividend growth, while they still may be a good investment for our strategy, we look for rising dividend payments. So that's another advantage to managing your own dividend investing portfolios. We might be selling a stock because of its slow dividend growth, but you might think it's still a solid investment. So that gives you can make the decision to keep it yourself. And we'll talk about some more former holdings soon. So the three pillars of dividend investing is what we often point to. That would be the valuation, the growth trends, and the financial strength and quality. So valuation is pretty much characterized by the stock's dividend yield. So as stock prices tend to fluctuate year-to-year basis, we look at those relationships between the yield and the price, and we create our 5-year dividend yield averages and highs and lows to give us sort of a range of where the fair value of a stock might be at a certain point, and that would be our basis for investment. We'll go into the full addition rules in a minute, but we also look somewhat at the price to earnings ratio, so the trailing and the forward price to earnings ratio. The trailing would be the trailing 12 months of earnings divided by, or the price divided by trailing 12 months of earnings, and then the opposite would be forward, so looking at earnings estimates for the up and coming year or even 2 years, and sometimes to see where the current valuation levels are for the company. Growth trends we touched on a little bit earlier, but these are some of the characteristics we analyze. So revenue, margins, the three big margins, earnings per share, dividend history, and dividend growth. Obviously, dividend growth being one of the main drivers, but it's hard to have dividend growth without strong revenue growth and strong margins to be able to support that dividend growth. So the company's ability to generate sales and then turn those sales into cash flow and earnings, that's basically what we look for. And then financial strength, so company's ability to continue to sustain the dividend into the future. So we look at earnings payout ratio, the free cash flow payout ratio. So those would be both looking at the current dividend level and comparing them to the earnings or the free cash flow per share. We look at interest coverage ratio and operating cash flow. So interest coverage ratio would be looking at the current interest payments, so debt that the company has, and seeing if they have enough operating cash flow to cover that every quarter. So these all can fluctuate quarter to quarter, so it's important that you maintain somewhat awareness of your holdings and what's going on as they can shift over time. So those are the three pillars of dividend investing that we like to say are our three pillars that the entire strategy is pretty much built behind. So when adding a stock to the portfolio, there's a bunch of different characteristics we look for, but these are them sort of laid out. So we look for a dividend yield that's greater than the 5-year average. We look for annual dividend increases over at least the last 7 years. So we want a company that's attractive on a valuation basis, but also increasing its dividend so that we can maintain that total return growth into the future. So dividend growth rate 5-year greater than 3%, and a sales growth rate over 5 years greater than 3%. So these are all on an annualized basis. So the company needs to, like we talked about before, exhibit that strong sales growth and earnings growth this year as well in order to hopefully continue to pay out increasing dividends into the future. We also do look at operating margin. Operating margin is important because that's how a company, if they have a higher operating margin, they have more operating income then, and so that would mean they have a higher free cash flow, so more ability to then pay out dividends if the management wishes to do so. Earnings payout ratio, similar to that, what percentage of the company's earnings are being spent on paying out to shareholders versus held or used for sometimes they use them for share purchase, but being reinvested then into the company would be the main. So we look for greater than or less than or equal to 50%. Some companies have historically higher payout ratios, so like utility companies or energy companies often will have payout ratios closer to 80%. So we do have screens that look for that in order to not avoid those type of stocks completely. So those stocks would be subject to a slightly less strenuous payout ratio, as well as times interest earned. Some companies have the propensity to just have more debt, and that just might be the industry, how the industry operates is a higher debt. So while we do look for companies with times interest earned over the last 12 months that is greater than or equal to 2x, again, with utilities, we look for those with 3x because they have higher debt. So we want to make sure that they're able to pay that. And then we also do monitor the debt to capital from the last quarter. So similarly, looking at how much debt a company has, making sure that they're able to service that. Times interest earned would be looking at short-term debt, where the long-term debt to capital Q1 of less than or equal to 50% would be looking at long-term debt. So looking at both short and long-term debt. For deletions, we look for companies that have extremely high yields. If a company is paying an extremely high yield, sometimes they will cut their dividend because they have a certain yield that they are targeting in mind. So that can be a red flag. We also look for companies that have yields below the benchmark. So the benchmark yield of 1.3%. We would try to stay within that 1.3%. We stay within 0.75 of that 1.3%. So around 1% yield would be the minimum threshold before we would start to look for a new candidate and then sell what we would consider overvalue. Also, companies that have a yield below their 5-year average low. So this would signal that they are at one of the higher prices that they have seen for the current dividend level over the last 5 years, which again, potentially overvalued. I would say that is the most common reason that a company is deleted, but we'll look at the 5 additions and deletions that we made during the year in a minute. Again, looking for revenue or shrinking, contracting growth over free cash flow, revenue, margins. Companies need to be able to pay their dividends, so shrinking revenue does not help their case. Interest coverage ratio, if it starts to decline below that 2.0 that we initially screened for, it could be indicator that the company is increasing its debt or decreasing its it would be EBIT, earnings before interest and taxes. So it would be decreasing its operating income. So both could be something to look into. And then if there's a better example or a better opportunity, so for example, a higher dividend growth or more attractive yield. In all cases, when we're making a deletion, we need to have a suitable candidate to replace it. So the ideas list is where that comes in, and we would start there and then further scrutinize and look through those to see which companies have potential to be added. I would say the only true portfolio deletion consideration would be a dividend cut. We saw this year with Intel, or this past year, 2023, with Intel. They cut their dividend by about 60%. So we decided to move on from the company because we are looking for those with a yield within a certain threshold or above the market, and then the ability to increase their dividends. So, but like I said, always looking for a candidate before we decide to sell. We need something that is that can be replaced. So in 2023, we saw 5 additions and 5 deletions. So I'm going to go through a couple of those right now that we've gone through the addition and deletion criteria. A lot of times, holdings have very similar addition rationale. So they have strong financials, the historical growth, high historical growth rates, and then attractive valuations at the time. So that can be said about pretty much every addition that we make to the portfolio. Whereas deletions are a little more, they offer a little more variety. So you can see a couple different reasons why we deleted stocks this year. So Intel, like I just previously said, they cut their dividend. They changed their capital allocation strategy, and while they have seen some appreciation since selling, they're no longer a stock that we would consider in the portfolio, as the company yields around 1% now. Hubble was sold for its high relative valuation, so its 5-year average, 5-year dividend yield average. Its 5-year dividend yield average was below its 5-year dividend average low, so it's below the lowest level seen over the last 5 years. So signaling that it was overvalued. Again, the stock has performed well since deletion, but its yield still suggests that it's overvalued, and like Intel, it's no longer a stock that we would consider, as we're looking for income-based investments. So while it still may be a good investment, it's no longer may fit along with the DI strategy of seeking the growing income stream and obtaining total return. Polaire or Walgreens is next. We sold Walgreens with its poor financial health, and dividend growth was pretty abysmal. They were growing their dividend by about a penny a year. So we decided that the dividend was one probably not sustainable for their current level, and then also not growing at a level that we'd like to see. So they had declining revenue, free cash flow, and earnings. The dividend was most likely unsustainable, and we saw that come true. Last week, Walgreens actually cut their dividend in half, and the company's declined around 12% since we removed it from the portfolio. And then Polaris, we sold Polaris, same thing for valuation. We thought it was overvalued based on the 5-year average yield was above or below its 5-year average low. So we sold it, and since then the stock has declined around 33.8%. So interesting to see kind of where the stocks end up. Tyson, they have weak financial strength and growth trends similar to Walgreens. The dividend seems unsustainable, and unless the company obviously starts to turn it around a little bit, but we felt it was time to move on from Tyson. So like I said, while a stock may be a solid investment, such as maybe Hubble, we think it's overvalued based on our strategy, and that's why we have established buy and sell rules, because it kind of takes the decision making out of it a little bit and allows us to be somewhat emotionless when making decisions. Here is the current portfolio and their valuation levels. So we can see that most of these stocks are in between their 5-year average high and their, I guess I can use my laser pointer thing here. If the stock is negative percentage wise, that would mean it's below this target. So for example, currently Abbott is yielding 2%, and their 5-year average high dividend is 1.8%, 5-year average is 1.5%, and average low is 1.3%. So then that would mean, based on their current indicated dividend of $2.20, and these average yields, these are the prices for the valuation range. So the high, the middle, the average, and the low. So currently the stock price is $112, and based on its 5-year average high, the company the company is around 6% away from that, from reaching that 5-year average high yield of 1.8%. So you can kind of see that no companies are currently below their 5-year average low. The closest would be Principal Financial. They have been in and out and close to this low. They just increased their dividend twice last year, so they are still below that. But if the price were to increase and the dividend remain the same, if the price were to increase 8.8%, then it would become a sell candidate. So kind of a good way to see where the current level of valuation is throughout the portfolio. This is a graph now of the dividend received by year for the DI portfolio. So if you've already looked at the monthly, this might look familiar. This is the same graph that is featured in the monthly newsletter this week, or this month for January. So we can see over time how the growing dividends can help pay off for our strategy for those looking to generate income. There's this, you can see pretty much a trend line going up. So this would be the beginning year, the inception year, 2012, and then now here we are in 2023, and we've received over $75,000 in dividends since inception, which is impressive because if you recall, the initial investment or inception value was around $100,000. So in 11 years, we've returned 75% of our initial investment. So you could think that even on an even longer term basis, you can recoup your investment and still have significant equity versus those that don't pay dividends. You would have to have sold some equity each year if you wanted to withdraw some gains. And then this yellow line here is the average dividend yield by year. So you can kind of see how it fluctuates with the market. Obviously, price and yield are inverted. So as price goes up, yields go down. So you can kind of see which years were good for DI and which ones were a little bit worse. Here's the current breakdown of the portfolio versus the benchmark IYY. So the benchmark would be that middle pie graph, and the right graph would be the breakdown of the DI portfolio. So you can see that dividend paying stocks are concentrated in a few sectors more heavily. Financial stocks and industrial stocks, to point out two, are more likely to pay than say technology stocks. So you can see technology stocks are around 8% of our portfolio right now versus around almost 27% of the benchmark. So you can kind of see why maybe performance differs over time than that of the benchmark, as the composition is pretty different in some sectors. And then here again is on the left is the tilt of the portfolio. So 40% of our, or 45% of our stocks are considered large cap, and then they're more core to value. As you can see, we have none that are considered growth stocks, mostly mid to large cap. So now we're going to review the model portfolio and market performance for 2023. So the state of the market in 2023. These are two of the cases, bull and bear case. So looking for a potential upside or downside. So upside would be maybe potential slowing inflation versus 2021, which was extremely high in 2022. Prices will remain elevated, so that would be a bear case. Just because inflation is lower doesn't mean that stuff costs less now. So something to keep in mind, that input costs will likely stay at the same level that due to inflation, they increase a lot, and then they'll stay at that level. And that's what the Fed's been working on, trying to create this soft landing. So that's why I put expectations harder soft landing. So far, it seems like it's been a soft landing, but I think there's still a good amount to go here. Now that we've sort of capped out at the top of this federal funds rate increase. And the federal funds rate pretty much competes with dividend yields as well. So it's important to remember that dividend yields, some companies that pay dividends may see some less favor in years where the rates remain high. So here's some of the total returns for the year. So S&P 26%, versus last year was down 18%, and you can see value still good for the year, 22%, but not quite the full S&P. And then this would be on an annualized basis on the bottom, 3, 5, and 10 years. So S&P growth still dominating over 10 years, value not far behind. And then this is the sector's returns for the year. Technology was dominant. Talk a little bit about Magnificent Seven and the impact it had, and as well as the bank failures. You can see last year information technology among the worst, and this year the best. So interesting to see the cyclical nature of the markets and how it sort of plays out year by year. So here was the top heavy market we were talking about, or I was going to say the Magnificent Seven. If any, I'm sure everyone's heard about that by now. So the largest 7 technology companies in the S&P: Apple, Google, Microsoft, Amazon, Meta, Tesla, and Nvidia. Those stocks equate for around, or that they sort of skewed performance this year for the S&P. So 72% of the S&P constituents underperformed the index in 2023, the 24.2%, and 35% of them were 35% of S&P stocks were actually down in 2023. So those 7 stocks saw an average return of over 100%. The S&P 500 returned 24.2% on a market cap weighted, but using an equal weighted method, it was 11.5%. So the top 10 constituents currently make up around 30% of the S&P. So there's a lot of weight that sort of controls the direction of how the S&P does for the year. Here is the dividend investing, the annualized returns on top, and then year by year performance. So this year, the dividend investing portfolio was up 4.6% on a total return basis versus the benchmark AAII, which was up 26.3%. And then looking at more of a dividend yield perspective, the Vanguard high yield dividend ETF and the ProShares dividend aristocrat, they're up 6.5% and 8.1% respectively. And I was looking at this bottom row down here. You can also see it here. So this would be the month of December. Dividend investing was up 7.4% versus the benchmark 5%. And then these are annualized returns. So since inception, DI has returned around 10.9% per year versus the 13.4% IYY on a total return basis. Again, this is now looking at the monthly performance. So while it is a little bit of cherry picking returns per se, it's interesting to see how the portfolio fared significantly better in the second half of the year, where the first half of the year saw the AI explosion sort of dominate the total market. as well as the regional banking issues that we saw. There's 3 bank stocks in the portfolio: Comerica, Huntington, and Town Bank, as well as 2 investment management companies and an insurance company. All these companies have been impacted by rising rates, but they were especially impacted in March, and when we saw Silicon Valley and First Signature collapsed. So from January to May, the DI returned negative 10.5% total return versus the AAII, which was up 9.1%. But then from June through December, the DI portfolio actually recovered very strongly and outperformed the benchmark and the comparable or other income-based strategies. So interesting to see the trends there. Here's the turnover for the year. So this is the amount of money basically turned over based on the value of the trades made. So it was a pretty average year in terms of turnover. We saw 14 trades, which is the average, as well as a average holding period of around 5.7 years and turnover of 70%. So 17% actually a little bit lower than normal, and the holding period a little bit higher. So pretty normal year in terms of transactions. The best and the worst performers in the portfolio for last year. So the best performer was Celanese Corp. They are a chemical company in Texas, actually, and they're up 59% this year versus they were down 7% last year. Polaris was actually in our top, one of our top stocks, even though we sold it in August. So we sold almost at the top, if you want to say. So that was pretty good for the portfolio. Look at the bottom. Pfizer was added in August, and it has been pretty disappointing so far this year. The company has strong financials and free cash flow and growing earnings, but unfortunately, somewhat dominated by news since the company was prevalent in their revenues from COVID. They saw pretty significant declines over the last 2 years in that revenue. However, excluding that business of that area of their business, they've actually seen positive growth. So the company has a large pipeline of drugs, and they just recently made a huge acquisition of a company called Seagen for $42 billion. And so they're trying to expand into oncology and oncology drugs more. So here you can see the list of all 29 stocks that were held during the year. So you can see more positive than negative, but and you can also see sort of the some of the trends, like healthcare companies. Some of them did better than others. And then versus last year was down 4.5%. So better than last year, but underperformed the benchmark. We're now going to go into some dividend investing resources. So we sort of looked at the portfolio and how we build the portfolio and what we look for in companies. So now we're going to kind of go through where to find stuff and different tools that you can use to either analyze your own investments or the DI portfolio, or do some research and try to find some dividend paying stocks. So you might have noticed that there's a new navigation bar on the model portfolio, and those of you who subscribe to multiple portfolios, it's uniform across all the portfolios now. So we see the home, obviously will bring you to home, but then there's portfolio where you'll find the performance, transaction, and strategy behind the portfolio. The insights is where you'll find the monthly and weekly articles, as well as the articles means the back page articles from each month. DI ideas, where you'll find the quant initial screen that we use to go through dividend investing stocks to try to find once you add to the model portfolio. Tools, you will find grader and screener, and then how to you'll find all the resources, and hopefully it will answer the questions that you're looking for. But if not, always feel free to reach out, and we will try to respond in a timely manner that can help you understand your problem. So the portfolio, like I said, this is where you would find the portfolio, and you can see you'll find performance, the transactions, strategy. So talking about sort of what we talked about, what our methodology behind the portfolio, and then the portfolio itself. And then here in the portfolio, there's many different tabs that can help you, analyze or track these various holdings if you do own them, or if you want to learn more about them. Here in the insights, if you click that, you would be taken to this page, and you would find the most recent. So this is from last Friday, but if you wanted to see our whole archive since 2012, so a weekly article every week since 2012, so hundreds and hundreds of articles, you can go here to previous updates, and they're sorted by year, so you can look back and read about different topics. Again, with the monthly report, if you make it to this area, you'll find the most recent. So this is this month's newsletter, and then you can also find all the old or previous reports down there. Again, categorized by year. The articles, I wonder if people know this is a pretty good resource as well. So you'd find this under insights and then articles. So these are all the back page articles from the monthly newsletters. So these are mostly educational based, just talking about most of the time different ratios or different things that we use to examine stocks. So it gives you sort of a breakdown of what we look for, or more educational tone versus the newsletter, which is more maybe conversational. The ideas list is where you will find all of the currently passing companies. So like I previously said, if a company is ever added to the portfolio, it will be from this list, but that does not necessarily mean that if a company passes the ideas list that it will be added to the stock. So this is sort of the base level that we take to find stocks that meet the strategy that we are going for, and then we do further scrutinization from there. So as of February or January 9th, there's 36 passing companies, 5 of which are current holdings. There's 26 companies that have a yield that is greater than the benchmark of 1.3. So that's one of the requirements we look for. While we do pass companies with a lower yield, we try to look for those that give us a yield at least the benchmark. And then we have not including the DI holdings. There's 9 utility companies passing, 1 technology, 2 industrial, 1 healthcare, 8 financials, which are all banks, 4 consumer cyclicals, and then 1 basic materials sector. So as you can see, pretty large diversification between the options that we have there. So now we have our poll question.
Yes, let me, I'll launch it right now, and then feel free to participate. We'll give it a few minutes to let everybody participate and vote on the poll, and then we'll release the results and we'll discuss a little bit as well. So I'm launching it now. The poll question is, how often do you examine the holdings on the dividend investing ideas list? And you can select either weekly, monthly, quarterly, annually, or never. So feel free to participate.
And so while you guys are voting, Jack, a number of questions have been coming across from our viewers here. One question that's kind of interesting is, if you had a choice, would you have a preference towards a company that is paying a higher yield, dividend yield, or has higher dividend growth?
That is a good question. Yeah, I think they're pretty circumstantial. I think that personally, I think for this strategy, I would look for a company maybe with higher growth. Oftentimes, companies with high yield, it's unsustainable, or there's maybe an underlying issue, or the company may be looking to cut its dividend soon. So obviously, you'd have to do some more research to find out, why the yield is high. But overall, usually dividend growth signifies, a healthy company that and management that's committed to growing its dividend.
Interesting. How about if you were using the ideas list and you could sort that ideas list? How would you go ahead and actually, how would you use the ideas list to help find some personal ideas or some additional ideas beyond what's in the
Yeah,
portfolio?
yeah. So usually, how I start when I head over to the ideas list is I actually do sort by yield. So I sort by highest to lowest, and so I can kind of eliminate those towards the bottom that have a yield that maybe not up to my benchmark level that I want to see. So usually those are the ones that are 1.3 and below. And then I sort of take my analysis from there and then sort of
Okay.
put them on an even playing field and then look at other metrics besides yield.
So you're looking for companies that are paying a meaningful dividend so that they're being considered, you're buying them primarily because the market values are dividend, but then within that, you're looking for some growth.
Right.
Okay, interesting. So Jenna, what are the results? Just a question about the ideas. Interesting. So 14% of our subscribers have never looked at the ideas list, but then the rest probably geared towards more the monthly or the quarterly. Any surprises there, Jack?
Um, I would like to see more people look at the ideas list that haven't before. But it does make sense that it's mostly centered around the monthly. The monthly often has the most eyes on it, and it's the most detailed publication that we put out for DI. So it makes sense that people around that time would also be looking at the ideas list.
So Stephen here had a question. You were showing, like on the current holdings, how the yield or the price compares against the high-low valuation range that's implied by the past relationship of yield to average yield to current dividend payouts. Is that available on our website? And if so, where can our subscribers find that?
Yeah, so you can find that in the ideas list for companies like that. I believe it's also on the portfolio, as well as if you go to the tools section, there's actually an Excel that lets you it gives you an example of how to build that high and low yield range. So then you can calculate that range for any dividend paying stock that you have the data for.
Okay, very good, thank you. Let's see here, sorry. If a stock is deleted from the dividend investing portfolio, can it be re-added in the future if it meets the criteria later on?
Yeah, so there's a couple of stocks that have been bought and sold throughout the history of DI. I believe Walgreens is actually one of them as well. So we don't discriminate against prior holdings. If they make sense as an investment and they pass our ideas and they look promising, then we will do what's best for the portfolio. So to answer that, yes, we do see companies repeat.
And how do you use the, I think you display the payout ratio, which relates to the amount paid via dividend against both the cash flow per share as well as earnings per share. How do you use the two in the portfolio decision-making process?
Yeah, so I think that cash flow per share is often used as it seems more reliable because companies are using their cash flow to pay that dividend. So it can give you a better idea. Sometimes earnings are negative for because they're inclusive of the dividend. So the dividend is already paid and part of that earnings per share. So by taking the free cash flow, you can see the pre-dividend, how much cash does the company have, and the level of which they're available to pay. So that's interesting.
So I guess what you're saying then, like for our portfolio, we look at both because the earnings per share may have some non-cash elements to it, or it could have some judgments, whereas the free cash flow, pre-dividend free cash flow, actually tells you over a period of time how much is available to actually fund that dividend. I know we've had trouble finding utilities that have a free cash flow coverage of their dividend. I think that's, if I'm not mistaken. I know it's
right. Yeah. Oftentimes you'll see utilities with free cash flows payouts greater than 100%. Because they invest pretty significant amounts into capital expenditures, which lowers their free cash flow. So it can lower it below that dividend level. But it's also good to see companies. Sometimes it does go up, but it's good to see why the free cash flow might have changed. If a company's increasing their capital expenditures, I would say that's better than if the company is seeing a decrease in their operating cash flow. So it's important to understand what affects those ratios and what that can mean.
And earlier in the presentation, I think you had a slide that showed the overall equity style and the sector breakdown of the portfolio versus the IYY. How did you calculate those? Where did you get those figures?
Yeah, so these are not market or they are market cap weighted. Sorry, I think, or at least.
I guess the question. Remember, the question was, where did you get these numbers from?
Oh, okay. So from AAII's data source, we use SI Pro. Every stock has a sector assigned to it. So these are the different sectors that are available from that. And then this is actually straight from the prospectus from iShares, so from BlackRock. They post these and they update them quarterly usually, and it basically gives a breakdown of their current holdings. It gives a list with percentages of what their current holdings are.
And the style box?
The style box, this is from Morningstar, but okay. So it uses their analysis, basically just showing the different market cap levels and then the different value, core, growth, different styles. Obviously, like we said, there's that tilt factor that can impact returns, as we've seen years where growth stocks, dominate. The DI portfolio might lag behind a little bit, but example for like 2022, the whole market declined around 70%, but DI only 4%. So sort of reduces that volatility and allows us to have a more stable investment, maybe.
And when it comes to diversification across these different sectors, do you do anything do you care about the allocation across sectors? Do you do anything if it's coming time to buy a stock for the portfolio? Do you look at the sector concentrations or not?
Sometimes, yes, but I would say for the most part, it doesn't impact it because there's such a wide variety of these dividend paying stocks. But for example, there is a stock called Microchip Technologies, I believe. They've been passing the DI screen for a couple months now, and we already have 2 semiconductor stocks. So I think I would be less inclined to add that stock and have 3 semiconductor stocks. While it might make our information technology or our technology breakdown increase more like the market, it would be slightly more concentrated. Similar thing, we have 3 regional banks in our portfolio. So yeah, I would likely stay away from adding another regional bank to maybe decrease that concentration a little bit.
One of our subscribers noted that he likes to take a look at where the current prices of a stock, in addition to the dividend yield, is the stock trading at near its high or low before being added to the portfolio, with the observation that he'd rather buy a stock that has not only an attractive yield, but is perhaps a bargain as far as price relative to its historic norm. Any comments or thoughts about that?
Yeah, I mean, we do something similar by looking at the relative yields. So the relative high and low takes into account the high and low from each year, and then it creates an average dividend based on that. So the average high yield, let me pull up where it was.
I guess in addition to that, though, I guess this particular member also likes to, in addition to that, look at not only that, but also just general how the stock price itself compares against its 52-week high low, just to kind of, and with a preference towards buying the bargains that might be a attractive valuation, but selling at a discount, kind of a contrarian view.
Yeah, sometimes we look at that, but oftentimes I think it doesn't, I don't know if it matters as much. I mean, maybe on the high side, but like you said, trying to find a bargain, obviously looking for those lower price stocks. Like for example, Pfizer was already down pretty significantly during the year, and that's what created its dividend to become, look attractive on a relative basis, and what made it past the ideas list. So oftentimes stocks that pass the ideas list are on that lower end because it's comparing to their 5-year relatives. So in terms of the DI strategy, yeah, most of the time stocks may be on the lower end, but you have to look out for potential, value traps or companies that are not going to recover.
Thank you. And when it comes to rebalancing the portfolio or deploying excess cash or reinvesting, how do you do it within the DI portfolio?
Yeah, so we do not participate in drips. We don't directly reinvest dividends received back into the holdings that we already have. We accumulate a cash balance, and then that cash balance is used in the future for additions or deletions. Oftentimes, the portfolio will get out of weight just simply by a company outperforming. So, for example, United Health is almost 2 times an average position size of the portfolio. So when the company gets too big, or if it's too low, we do try to rebalance back to the average. So if a company were to go, or stock were to go above the 2.5 times average, we would shave it back down to closer to 1, and then we could use that excess cash to then reinvest into underweighted positions. But we only reinvest into stocks that are currently passing the ideas list. So there's 5 right now. We're reinvesting into Tractor Supply this month because it's underweighted, but it's the only underweighted of the 5 that are currently passing the ideas list. So there's 5 stocks passing, but Tractor Supply happens to be the only underweighted one. So we're using our cash balance to try to bring it back to that closer to the equal weighted portfolio that we try to maintain.
Thank you. And when it comes to the dividend payment cycle of the holdings, do most of the companies in the portfolio, how often do they pay dividends, and do you try to do anything about having a regular flow of income over the course of the year?
Yeah, we don't seek out specific months, try to stack up and gain portfolio or income into certain months. It happens to work that way a lot of times. So we only look for companies that do pay quarterly dividends, as opposed to some like REITs or MLPs do pay monthly distributions. And then it sort of just is how it works out. Like sectors often report earnings in similar timeframes, and so then they declare dividends in similar timeframes. So it does happen that we have some months that have 7 or 8 dividend payments versus some months that may only have 1, but we don't at all try to stack them per se or gain an equitable payout.
And when it comes to things like share repurchases, anything that you look for that might be a sign that a company is ready to to do anything as far as repurchases?
As far as a company is going to be repurchasing its own stock?
Yeah.
Um, yeah, I mean, it's similar to dividends. There's companies that their management have historically tried to repurchase stocks, or they have share repurchase programs. So you can look at the shareholder yield of stocks to see which is the total, which would be the yield plus the share buyback percentage. So you could see where a company is going to be more inclined to repurchasing shares if they have in the past, oftentimes, or if a company is under valued. Usually, if a company is undervalued and the management thinks it's undervalued, or if its stock price is low and the company thinks it's undervalued, management, they will increase their share repurchases. So could be a sign of undervalued if a company is engaging in share repurchases.
And I guess as far as, I guess that was Jen already answered that question. If you were to start off now, like if you wanted to invest $100,000, what would be your strategy for buying into the portfolio? How would you go ahead and do that? Kind of, I guess we'll probably end on that question.
Yeah. First, I would look at the ideas list and see which of those is passing currently. So that would be stocks, that are passing our quant screen, and they have the what we look for during our addition process. They have the initial values that we're looking for. You can buy into the entire portfolio if you wanted to, but some stocks might be at different valuation levels or different valuation periods than when we bought them, or they might have different financials. So it's important to do some research and see maybe of the companies that are currently held, maybe there's some that still might have a lower valuation or seem undervalued, which would allow you to buy into the portfolio. But I would say the ideas list would be a good starting point to try and find companies that are part of the portfolio that are still passing. So right now, I think that's 5. Usually, if you're trying to make a portfolio, we aim for 10 or more for our portfolios. So you can look at the entire portfolio and make your decisions based on what you think of.
Would you go by sector? Would you go by? I mean, I guess historically speaking, I think like 15 sort of is that magic number of
right.
Where the company specific risk kind of goes down, provided that they're sort of in different industries. So would you do it by industry? Would you do it by valuation or a mix?
Yeah, I think like we sort of talked about, there's a lot of companies that different sectors that pass. So I think if you were to do the research and find companies that you like, you would gain that natural sort of diversification where you have a decent mix of different sectors and not exposing you to too much concentration.
Thank you. Well, I know we've been a little bit over our time, but great presentation. A lot of good questions here from our audience. And Jenna, if you're around, anything you want to talk about before we finish for the day?
Definitely. So today is I posted a link actually while you guys were talking about and answering the Q&A session, and there's a link in the chat right now. But this is the 3rd event of our AAII Model Portfolio Review Week. And so each day this week we host a live webinar. They're all at 2 p.m. Central, and they're accessible to only subscribers. So basically, if you're looking forward to VMQ stocks tomorrow and then SSR on Friday, if you'd like to join one of those, we have a link that you can click on, and I will also include it in the links and resources document after the presentation. But you can, it's for just $1. You can get access for a 30-day trial for either a VMQ stocks or SSR. And then also you will get a subscriber access to the webinars for the rest of the week. So very exciting. So hopefully you will all join us for tomorrow's presentation and then Friday's presentation. And I just wanted to thank, first of all, I want to thank Jack so much for guiding us through our annual review of the DI portfolio, and then also John for moderating such a wonderful Q&A session. Was there any last remarks that you guys, I wanted to open the floor before I wrap up the presentation?
Actually, I'm going to answer one question that a member just had here, and it has to do with how many shares to buy when it comes to a portfolio. So, I mean, we recommend you look more at the average position size that you want to go into. So, if you're going to be investing $100,000 and you want to allocate it across, 20 stocks, that'd be roughly what, 5K a stock. And you simply take a look at that position size, you divide that by the share price, and that'll tell you approximately how many shares you want to acquire. So the focus here, I think, is to have roughly equal dollar amounts and not worry so much about the number of shares, especially nowadays with commissions being what they are. So it's so much easier just to go ahead and buy small positions in these securities. So with that, Jack, I'll let you finish things up, but thank you so much for your presentation here today. A lot of great information. Thanks so much for our audience for tuning in and asking so many great questions as well of us. Jack, take it away.
I don't know where my slide went. There it is. Just gonna say thank you to everyone. My first webinar, and I was a little bit nervous, but went pretty smoothly, I think. And thank everyone for tuning in. And as always, if you have any questions, feel free to reach out. And over the next couple of days, I'll try to look at the other questions I wasn't able to answer in the chat and potentially reach out as well or answer them in some fashion. So just thank you everyone for attending today.
And Jack, just so you know, you have at least one DI subscriber that went Go Cowboys. So I think someone's trying to break your Green Bay Packer heart.
Well, I'm going to the game on Sunday, so hopefully it's not too bad. Hopefully it's okay.
I'm sure it's going to be much warmer in Dallas than it would be up in.
You'd think so, but it's actually going below freezing this weekend on Monday and Tuesday for the first time this year. So people are kind of freaking out that the power grid is gonna shut down or something. Maybe we'll see.
I'll look for you and your cheese head.
Yeah.
Take care. Thank you.
Thank you, everyone.
And I just wanted to end the presentation by saying, feel free to email Jack at his specific email listed on the screen. If you have membership, questions about cost, pricing, any other technical issues or anything like that, feel free to email us at members@aaii.com. And if you haven't delved into the dividend investing portfolio yet and you want to, you can visit di.aaii.com. And there you can obviously view our robust ideas list. You can try out the dividend grader or screening tool. You can view portfolio performance, read weekly commentary, monthly newsletter, and also additional insights, as well as check out the how-to section. That's a great place to start if you want to get into the DI portfolio and haven't yet. And to mention again, because we received a few questions in the chat during the presentation, that this webinar is recorded, and a replay of the event will be available tomorrow, or actually available early next week on the Dividend Investing website, along with links to this presentation's handouts, as well as any resources that we discussed today, and also any resources that we put in the chat as well. And with that, we wish all of you viewing good health, good fortune, and great rest of your afternoon. Thank you and take care.